Is one of the world's most boring stocks about to outperform the tech darlings? While everyone is obsessed with the AI boom, I'm going to show you why Pepsi might be one of the smartest buys on the market right now, with a potential 12% annual return. This consumer giant has fallen to a valuation we haven't seen in years, but there are new catalysts that almost no one is talking about, and I'll give you my exact price target. So why are we talking about Pepsi? The stock has been pretty stagnant, but that's exactly what creates the opportunity. Pepsi is an absolute monster. It's the world leader in salty snacks, think Lay's, Doritos, and the #2 player in global beverages. This diversification across snacks and drinks gives it incredible resilience. Right now, the stock is trading at a low forward PE. That's just the stock price divided by its expected earnings for the next year, and it's a simple way to see if a stock is cheap or expensive. For Pepsi, this metric is at a historic low. On top of that, it offers a high dividend yield and a long history of increasing that dividend every single year. It's a true income machine. But it's not all good news. Organic growth has slowed down. Why? Inflation and higher interest rates are squeezing consumers. People have less money to spend, so they're buying less or opting for cheaper store brands. Pepsi also operates with significant debt, which is a risk if interest rates stay high. This is where most people stop their analysis, but the story is just getting interesting. If you're getting value from this kind of deep dive analysis that goes beyond the headlines, take a second to subscribe to the channel. It's free, and it's the best way to support this work. Now, let's talk about the catalysts that could send this stock soaring. First, the company isn't standing still. It's pushing product innovation and expanding internationally where there's still massive room to grow. Second, and this is key, Pepsi just hired a new CFO from Walmart. This brings serious retail experience and a sharp focus on cost discipline right when the company needs it most. Third, Pepsi has a strategic stake in Celsius, the energy drink company. This was a brilliant move that positions them perfectly in one of the fastest-growing beverage categories. And finally, the macro environment. If inflation continues to cool and interest rates eventually come down, that's a double win for Pepsi. Consumers will have more money to spend, and Pepsi's debt becomes cheaper to manage. So what's a fair price for Pepsi? Based on my valuation model, which accounts for future growth and a return to a more normal PE multiple, I have a price target above $200 per share. If that target is reached within the next 4 to 5 years, we're looking at a potential double-digit annual return, over 12% when you include the generous dividend. That's an attractive return for a stable blue-chip company. Now, you can't analyze a stock in a vacuum. Later, I'll tell you what the broader market is signaling, but first, we need to talk about the elephant in the room, Nvidia. The entire market feels like it's at an inflection point, and it all hinges on Nvidia's earnings. Their results will tell us if the massive investment in AI infrastructure is justified or if we're in a bubble. The key number to watch is their data center revenue. Nvidia's stock price, despite the hype, has been moving sideways. This isn't a bad thing. It's a healthy consolidation within a major uptrend. It's building a base for its next move. What could trigger that next move? Liquidity. Put simply, liquidity is the amount of money flowing through the financial system. We've seen a period of liquidity contraction, but the worst seems to be over. There are signs the U.S. Treasury may need to inject liquidity back into the system. When that happens, assets like a strong Nvidia and even Bitcoin tend to do very well. So what are other stocks telling us about the economy? We're seeing a split in the retail sector. Lowe's is doing well. Consumers are still spending on home renovations, but Target is struggling. They're on the wrong side of the economic cycle, facing weak demand. This shows us that the consumer isn't dead, but they are being very selective with their money. And in tech, we're seeing some nervousness. Investors have started taking profits in big names like Microsoft and AMD after their huge run-up. Valuations are a concern. But at the same time, Google is fighting back hard in the AI race with its new Gemini 3 model, which could be a game changer for them. So to bring it all together, we have an undervalued consumer giant with clear catalysts for a rebound and the potential for solid double-digit returns. At the same time, the tech market, led by Nvidia, is at a critical juncture where sky-high valuations are being tested. This is a moment that calls for careful stock selection, not just blindly buying what's popular. If you want to stay ahead of these market shifts and find opportunities others are overlooking, make sure you're subscribed with notifications on. Now I want to hear from you. What do you think? Are you buying defensive value names like Pepsi, or are you sticking with the AI trend? Let me know in the comments below.